At first glance, manufacturing cities look steady. Plants are running. Parking lots fill before sunrise. Job boards still post openings. Paychecks still arrive. And routines feel intact. From the outside, nothing appears broken, which is exactly why this moment is easy to misread. If you live near these cities or track them closely, the signal feels familiar. Employment exists, wages flow, communities function. By traditional logic, housing demand should follow automatically. Jobs have always been the engine. Where people work, they buy. Where pay feels stable, homes should move. But stay with the data a little longer and the rhythm feels off. Listings linger. Showings happen without urgency. Buyers ask careful questions, then pause. The factories didn't shut down, yet decisions slow anyway. Work remains, but commitment thins. That contradiction creates quiet tension. We're trained to equate employment with confidence. When layoffs aren't rising, fear shouldn't exist. When income appears secure, hesitation shouldn't either. And yet buyers hesitate. Not loudly, not emotionally, they just wait. This is the trap. Manufacturing cities often feel insulated because employment looks tangible. You can see the shift change. You can hear the machines. It feels real in a way abstract markets don't. That visibility creates comfort, even as housing behavior quietly changes underneath. If you've been watching closely, you've probably sensed this gap already. Conversations take longer. Offers don't follow tours as quickly. Interest feels polite, measured, conditional. Nothing dramatic happens, yet progress feels heavier than it should. What's fading here isn't work. It's confidence in what that work guarantees. Buyers are no longer asking whether jobs exist. They're asking whether those jobs translate into long-term stability, mobility, and optionality. Employment alone no longer answers those questions. That's why demand softens without headlines. People don't panic. They reassess. They wait for clarity instead of rushing toward assumptions that once felt safe. Manufacturing cities still look employed, and that's precisely why the slowdown hides so well. The surface stays calm while psychology shifts underneath. If you notice that early, you're not pessimistic. You're observant. Subscribe and hit the bell. Shifts don't announce themselves. For decades, manufacturing cities followed a simple rule. If the jobs were there, housing demand followed. A steady paycheck meant predictability. Predictability meant planning. And planning almost always ended with buying a home close to work, close to routine, close to a future that felt understandable. That logic wasn't naive. It was earned. Manufacturing jobs once promised longevity. You learned a skill, stayed with a plant, advanced slowly, and retired from the same ecosystem that raised your family. Income didn't just arrive, it repeated. And repetition created confidence. Buyers didn't overthink timing because the path ahead felt stable enough to trust. Homes moved because decisions felt safe. Not exciting, not speculative, just safe. When employment anchored a community, buyers assumed the next 10 years would look roughly like the last 10. Housing demand didn't require urgency or persuasion. It emerged naturally from the rhythm of work and life reinforcing each other. That model worked because stability and certainty were aligned. A job didn't just pay today, it implied tomorrow. It implied location, it implied continuity. Buying a house felt less like a choice and more like a step in a known sequence. What's changed is not employment itself. It's what employment promises. Jobs still exist, but they no longer guarantee predictability. Skills shift faster. Plants modernize. Contracts change. Even stable roles feel conditional in ways they didn't before. Income arrives, but its future shape feels harder to visualize. This is where cognitive dissonance creeps in. Buyers are employed, yet hesitant. They aren't afraid of losing income tomorrow. They're unsure how adaptable that income is over time. Will this role still exist? Will it exist here? Will it move, automate, restructure, or demand flexibility housing can't easily accommodate? That uncertainty breaks the old chain. Income security no longer translates automatically into decision confidence. Buyers aren't questioning whether they can afford a home today. They're questioning whether the commitment still fits their future options. Manufacturing cities feel this first because the old logic was so strong. When the guarantee weakens, the contrast feels sharper. Employment remains visible, but certainty fades quietly. Housing demand doesn't disappear, it decouples, it waits. Buyers pause not because they distrust their jobs, but because they no longer trust the assumptions those jobs once carried. This isn't pessimism, it's recalibration. Stability used to mean safety. Now safety requires flexibility. And when buyers sense that shift, they slow down even while paychecks keep arriving. Stay with us. Employment isn't certainty anymore. The buyer who built manufacturing cities is not the buyer shaping demand today. For decades, these markets were powered by a specific mindset: loyalty to employer, loyalty to place, and faith in long timelines. You got hired, you stayed, you bought a home, and you planned forward. Housing wasn't a flexible decision. It was a declaration of arrival. Commitment signaled stability, and stability was rewarded. That buyer was settlement-oriented. They valued roots over options. Proximity to the plant mattered more than future resale. A home was protection, not a variable. Even when cycles came, people trusted the system to rebound. Waiting felt unnecessary because continuity felt guaranteed. Manufacturing cities thrived on that predictability, and housing demand reflected it. Today's buyer was trained by a different environment. They didn't inherit confidence. They learned caution. Layoffs arrived without warning. Automation replaced roles that once felt permanent. Global shocks disrupted supply chains, schedules, and security. None of this produced panic. It produced adaptation. Buyers learned that permanence could disappear quietly. That lesson reshaped behavior at a deep level. Modern buyers are mobility-focused and exit-conscious. They don't ask whether a job exists today. They ask how portable the decision will be if conditions change. They imagine what happens if a plant scales down, if hours get cut, if contracts shift. Housing is evaluated as a scenario, not a milestone. This is not fear-driven behavior. It's conditioned behavior. Buyers watched commitment become a liability in previous cycles. They saw neighbors stuck, not because they made bad choices, but because flexibility wasn't built in. That experience rewired priorities. Flexibility became safety. Optionality became confidence. For sellers, this creates discomfort. Manufacturing cities still feel familiar. Jobs still exist. Communities still function. It's natural to expect buyers to behave the way they used to. When they don't, sellers assume interest has faded. In reality, interest has become quieter and more internal. Buyers are still engaged. They're just verifying assumptions before attaching emotionally. The old buyer trusted the system. The new buyer trusts themselves. That shift changes timelines, negotiation dynamics, and conversion rates. Speed no longer signals seriousness. Patience does. Walking away doesn't feel like loss. It feels like discipline. That discipline slows visible demand without eliminating it. This is why housing demand fades before cities visibly change. Buyers don't wait for decline. They adjust behavior early. They reduce risk exposure before headlines confirm anything. Manufacturing cities haven't failed them. Experience taught them to adapt ahead of outcomes. Expecting this buyer to revert is the mistake. Conditioning doesn't reset because conditions look stable again. Once flexibility proves protective, it becomes permanent. Demand doesn't vanish, it transforms. And markets that depend on commitment must adapt to buyers who prioritize resilience instead. Understanding this shift isn't pessimistic, it's clarifying. Buyers didn't abandon these cities. They renegotiated how they engage with them. Hit the bell. Buyer psychology doesn't rewind. Manufacturing towns are full of signals that feel reassuring at first glance. People still know each other. Neighbors wave, plants run shifts, homes get tours. Agents hear familiar last names and shared histories, and that familiarity feels like momentum returning. But look closer, and something quieter is happening. Tours don't turn into offers. Conversations stay friendly, but unfinished. Buyers walk through homes they recognize, in streets they trust, and still step back. Nothing feels rejected. It simply pauses. This is where sellers misread the moment. Community stability gets mistaken for housing demand. Because people still live, work, and gather locally, sellers assume buying must follow. The town feels intact, so the market must be too. Yet housing decisions aren't driven by belonging anymore. They're driven by optionality. In factory towns, buyers rarely say no outright. Rejection would feel personal. These are shared spaces, shared employers, shared networks. Instead of declining, buyers go quiet. Silence replaces refusal. Interest fades without confrontation, and sellers wait for follow-up that never comes. That silence is powerful information, but it's easy to ignore. Sellers tell themselves buyers are being cautious, thoughtful, respectful. They assume time is neutral. Meanwhile, buyers are learning something else. They're discovering that waiting costs them nothing. They can remain part of the community without committing to a mortgage that limits flexibility. Steady activity reinforces the illusion. A showing here, a conversation there. The home stays visible, so it must still be wanted. But visibility without conversion changes meaning. Buyers interpret lingering listings as proof others already evaluated and hesitated. Familiarity stops signaling safety and starts signaling stagnation. This is social proof reversing quietly. What once meant desirability now suggests optionality. When urgency disappears, activity no longer supports price or speed. It simply extends timelines. The danger isn't that demand vanished. It's that sellers don't notice when it stops converting. By the time concern appears, leverage already shifted. Buyers feel calm. Sellers feel confused. Manufacturing towns amplify this effect because relationships soften signals. Politeness delays clarity. Community warmth masks hesitation. But markets don't move on kindness. They move on commitment. Understanding this isn't alarmist. It's corrective. Activity is not confidence. Stability is not momentum. When buyers disengage quietly, the message arrives without noise. That delay reshapes pricing power without anyone announcing it. Sellers hold expectations steady. Buyers quietly recalibrate offers, timelines, and terms. Each week that passes teaches restraint. No panic appears, yet options narrow. When realization finally arrives, it feels sudden, even though behavior changed long before awareness did, slowly, predictably, and without conflict. That gap between movement and meaning is where communities misjudge markets, assuming familiarity protects value when it no longer does there. Subscribe. Activity isn't confidence. Housing. Demand doesn't fade everywhere at once. It thins selectively, following structure long before prices respond. In manufacturing cities, buyers disengage first where the future feels narrow, even if the present still works. These places don't look broken. They look complete, which is why the slowdown is missed. Single-industry towns are usually first. When one employer anchors identity, income, and confidence, housing demand depends on a single story continuing uninterrupted. As long as the plant runs, life feels stable. But buyers think further ahead. They ask what happens if that story bends, not breaks. If exits feel limited, commitment feels risky. Homes don't lose value immediately. They lose urgency. Aging infrastructure cities follow closely. Streets, utilities, schools, and housing stock reflect past strength, not future momentum. Buyers sense when maintenance replaces growth. Even with steady jobs, the environment feels static. That stagnation changes how long people imagine staying. If the city feels like it's preserving rather than evolving, buyers hesitate. They don't reject the place, they delay belonging. Automation-exposed regions add another layer. Employment still exists, but the trajectory feels uncertain. Workers may feel secure today, yet buyers imagine tomorrow. They understand that automation rarely eliminates jobs overnight. It reshapes them gradually. That gradual shift is enough to slow housing demand. Buyers protect flexibility when they can't see how skills translate forward. Cities dependent on overtime or contract labor soften next. Income looks strong on paper, but it feels conditional. Buyers underwrite consistency now, not peaks. When earnings rely on extra shifts, variable schedules, or short-term contracts, mortgages feel heavier. The house becomes a fixed obligation tied to fluid income. That mismatch changes behavior quietly. What connects these places isn't fear, it's narrative fragility. Each relies on a future story that feels thin under scrutiny. Buyers don't need certainty to act. They need believable continuity. When continuity depends on too many assumptions holding, patience becomes the rational choice. This is where sellers misinterpret silence. They assume buyers are waiting for better rates or timing. In reality, buyers are waiting for clarity that never arrives. They remain engaged with the town, the job, the community, but they postpone anchoring themselves to a property that limits options. Resale demand matters more than current employment here. Buyers imagine the next buyer before they imagine move-in day. If the pool feels narrow, commitment feels asymmetric. They sense that selling later may require concessions even if prices stay flat. That perception alone slows decisions. Lifestyle stagnation compounds everything. Manufacturing cities built around routine offer comfort, not excitement. That worked when predictability equaled security. Now buyers value adaptability. If the city feels like it offers one stable version of life rather than multiple paths, demand softens. None of this is emotional, it's structural. Buyers aren't pessimistic, they're pragmatic. They disengage first where optionality feels thin and narratives feel brittle. That disengagement shows up as longer timelines, fewer offers, and polite interest without follow-through. This pattern repeats every cycle because structure changes before sentiment. Jobs can remain while confidence thins. Communities can feel intact while housing demand fades. The shift is quiet, selective, and easy to miss until it spreads. Seeing it early isn't negative, it's perceptive. Markets always release pressure where the future feels narrow first. Hit the bell. This pattern repeats every cycle. Prices haven't fallen yet, and that feels reassuring in manufacturing cities. Paychecks still arrive. Plants still run. Union protections and fixed mortgages reduce distress, so sellers don't feel forced. That stability delays price movement, but it doesn't stop demand from thinning underneath. One reason prices lag is anchoring. Owners remember the last strong sale and treat it as truth, not history. Adjusting feels like surrender, so waiting feels safer. Loss aversion keeps listings static even as interest fades. Another buffer is structure. Union contracts, seniority, and predictable wages reduce panic. Fixed-rate mortgages lock payments in place. When sellers don't need to sell, prices don't collapse. They linger. Sellers read that as strength. Buyers read it as time. Comparable sales add another illusion. Comps look backward. They reflect yesterday's confidence, not today's hesitation. A market can slow quietly for months before data acknowledges it. Buyers understand this instinctively. They don't wait for numbers to confirm what behavior already shows. This is why buyers aren't waiting for price cuts. They don't need them to gain leverage. Time already does that. Each quiet week reinforces optionality. Sellers waiting feel patient. Buyers waiting feel powerful. When price finally moves, it's rarely gentle. By then, options narrowed. Negotiations harden. Flexibility disappears. Buyers feel confirmed, not opportunistic. That shift happens calmly, without panic or headlines, but the outcome is the same. The mistake is watching price alone. Behavior always leads. Showings thin. Timelines stretch. Effort softens. Those signals matter more than comps. Buyers already adjusted to this reality. They move quietly, selectively, and with discipline. None of this requires fear. It requires attention. Manufacturing cities don't fall first. They pause first. Prices follow later, when patience runs out and clarity replaces comfort. Those who notice early keep choice. Those who wait for confirmation inherit pressure. Understanding this preserves dignity. It allows sellers to decide, not react. Buyers already know the sequence. Behavior moves first. Price follows last. Subscribe and hit the bell, because this rule never changes. Even when markets feel calm and jobs still exist everywhere nearby today, quietly unfolding without warning signs yet. That awareness creates leverage without confrontation. Sellers who see behavior early can adjust messaging, pricing, or timing before urgency appears. Buyers who understand lag don't chase discounts, they wait for alignment. Markets resolve slowly, then suddenly, and the prepared are never surprised. Calm observation beats prediction. Sequence beats sentiment. That's why watching behavior matters more than watching price alone, especially where employment still looks solid on the surface. Subscribe. Prices follow behavior, always, even in factory towns that feel stable, until they don't anymore at all for those unprepared to notice early signals forming beneath visible calm conditions today. When housing demand softens in manufacturing cities, control doesn't disappear, it changes hands. Most people feel lost because they expect urgency to equal value. But markets don't reward optimism during transition, they reward alignment. As urgency leaves factory towns, leverage redistributes quietly toward those who adapt instead of wait. Adaptive sellers feel this first. They stop interpreting fading demand as rejection and start treating it as information. Instead of waiting for buyers to return emotionally, they clarify pricing logic, reduce friction, and simplify decisions. That transparency restores trust, and trust still converts when urgency doesn't. Patient buyers gain control at the same time. Without competition forcing speed, they evaluate calmly and negotiate without pressure. Walking away no longer feels like failure, it feels like discipline. That identity shift creates leverage without confrontation. Long-term operators thrive in this environment. They understand that quiet markets reveal structure. Instead of chasing activity, they study which homes convert and why others stall. As noise fades, mispricing becomes visible and risk becomes measurable. Timing replaces boldness, and patience replaces prediction. What connects these groups is composure. Control now belongs to those aligned with reality, not those hoping conditions revert. Confidence becomes quieter, but more durable. This moment challenges identity in factory towns. For decades, decisiveness signaled strength. Now, restraint signals intelligence. Calm operators don't rush to validate belief, they let behavior confirm it. That posture preserves options while others wait for certainty. Nothing here requires predicting collapse or recovery. It requires orientation. When demand softens, markets rebalance rather than break. Leverage flows to those prepared to act without panic and wait without fear. If you feel steadier while others feel anxious, that's not hesitation. It's positioning. Staying clear preserves choice when urgency fades. That clarity compounds into better outcomes over time. Stay with us, because clarity is leverage now. It allows sellers to decide before pressure dictates terms and buyers to commit only when alignment appears. In places built on routine, that flexibility matters more than optimism. Those who recognize the shift early keep dignity, timing, and control. Those who don't eventually react under constraints they didn't see forming. This phase rewards presence, patience, and honest assessment of what demand is becoming. It is quieter than a boom and steadier than a bust. Understanding that difference is how control is regained without force. That's the advantage hidden inside softening manufacturing demand for prepared participants everywhere. Manufacturing cities aren't dying, even if the conversation around them feels heavier right now. What's changing isn't the presence of work or the character of these communities. What's changing is how buyers imagine their future inside them. That shift happens quietly, long before any chart or headline acknowledges it. For decades, these cities were evaluated through certainty. Jobs existed, routines repeated, and life felt predictable enough to commit to. Today, buyers still respect that history, but they no longer rely on it alone. They ask different questions. They imagine different timelines. They measure flexibility instead of permanence. That isn't rejection, it's reassessment. This is why the moment feels confusing. Streets still look familiar, plants still run, neighbors still show up. Yet decisions slow, offers thin. Silence replaces urgency. Nothing dramatic breaks, but confidence becomes conditional. Manufacturing cities aren't losing value first. They're being repriced psychologically, one decision at a time. Understanding that difference changes how you experience this phase. Reactors wait for proof. They watch prices, headlines, and outside validation before adjusting. Observers watch behavior. They notice effort, hesitation, and timing. They understand that markets don't announce transitions. They reveal them through patterns before numbers ever move. If you live in or follow one of these cities, start there. Watch how long decisions take. Notice where interest lingers without commitment. Pay attention to what buyers ask about the future, not just the property. Those signals matter more than optimism or fear. This isn't about predicting decline. It's about staying aligned with reality as it shifts. Manufacturing cities will continue to matter. They will still house work, families, and identity. But the terms of commitment are changing, and buyers are adapting before sellers are forced to. In the next video, we'll talk about how time eventually forces price, even without panic or headlines, and why patience reshapes outcomes long before charts do. Stay subscribed. This cycle rewards the prepared, especially those willing to observe early, stay grounded, and respond with clarity instead of urgency when pressure finally appears. This moment asks for awareness, not fear. Communities evolve before they announce it. Those who slow down and notice gain perspective others miss. If you're seeing shifts where you live, share them. Collective observation sharpens insight and reduces noise. That shared clarity helps everyone navigate change with steadier expectations and better decisions. Over time, this mindset becomes the advantage in uncertain markets,